Securities come in the form of stocks, options, mutual funds, and bonds. Stocks trade in multiples of 100, which are called lots, with the occasional odd lot trade for the amount less than 100. These trade in pennies, which changed from eighths some dozen years ago. The value of each one of these in terms of dollars is 1 for 1. A point is $1. The settlement for these, you've got to have the money in there in 2 days, and you have to put up at least 50 to 90% depending on the security. And if you do borrow the remaining amount, we call that margin. On the stocks, you can use short limit stop orders, which we'll describe in a moment. New York and American exchange traded securities have a 1 through 3 letter character or symbol, and NASDAQ over-the-counter have a 4 or 5 letter stock ticker symbol. If they are preferred or warrants, they have special symbols which depend on the quotation system. Options, which are a contract based upon the underlying security, are in 1 units but are for 100 shares. These typically trade in nickels and dimes if it's under or above $3, and thus if it's for 100 shares for one option, the dollar amount is 100 times the number of options. These have same-day settlement. You've got to put up 100%, no margin. And you can use short limit stop orders. There are some options now trading in pennies and nickels, and this list from currently about 2 dozen will expand on March 28th of 2008. The New York American traded options take the underlying symbol for the option root, and if it's NASDAQ or over-the-counter, they create a 3-letter symbol with a special option root now being created. Call options, which we'll describe in a later presentation. For calls, use the first 12 letters of the alphabet, January through December. And for puts, the next 12 letters of the alphabet, January through December. The strike price or contract price is in multiples of $5, using the 20 letters of the alphabet associated thereto. And if your, let's say, stock price is at 215, they just roll it over so they'd use the same symbol as 15, which here would be the letter C. Well, the next 4 letters are used for low-priced options, such as 7.5, 12.5, and so on. Occasionally you have a special case, such as a stock split, and the stock, let's say, priced at 40, 3-for-1 stock split. That now would be $13.33. That's not a standard strike, so they create a special symbol, a Y or Z, which only exists until the option expires. Mutual funds trade in 1/1000ths. They're purchased in dollars, but sold in multiples of 1/1000ths. The pricing on these is in pennies, and the amount dollar for price is 1 for 1, with typically a day settlement, and you can typically buy these with 50% down. There's no limit, stop, or short order on these. You just merely take the next closing price the next time the mutual fund is quoted. Money markets have a 5-letter character, with the last 2 characters being double X's, and regular mutual funds have a 5-letter character with the last character being an X. Bonds, corporate bonds, trade in $1,000 multiples and have price increments of 1/8. And all bonds are priced as percentage points of face value as 100%, so thus 1 point of 1,000 is $10 for a corporate bond. Have 2-day settlements, and here you can typically buy them with as little as 35% down, and you can use limit and stop and so on orders. Government bonds are typically $10,000 face, trade in 30 seconds, and since 1 point on 10,000 is $100, you would multiply it times 100, and the requirements on these can vary. Well, if you take a typical position hoping the price rises, you would use an order to open to buy, and then close or terminate it later by taking, hopefully, your profits with the price rising by selling it. The reverse is possible, a short order. That is, you open to sell, hoping the price falls, and close it back later with a buy order. Terminologies here are bulls and bears come to mind. Bearish coming from the idea that you going to shoot bear, as is in the garment rag trade. What they do first is they sell the contract and then go get the goods later. Well, the bear traders used to go and get the orders, then sell them and to get the money, and then go and get the bear, hence the term being bearish. Bullish, the horns are on top, you hope the price rises. You can do one or the other, but if you do both, as the joke says, pigs get slaughtered. Well, I've created a table here to show the different types of option and stock specifications that you have to use for each and every order. You either open or close, buy or sell, place a market order, which typically is unattractive because that means if you're buying, you'll pay a higher price from somebody else's limit, or if you're selling, you'll get probably the lower price from somebody else's limit, and a stop order, which we'll describe in a moment. And there's something called fill or kill, which is immediate, either it's there or not, and execute on close, which is used by mutual funds and professional traders. It just takes the last price of the day. The limit order is a price that's better, meaning if you're buying, it's below, and if you're selling, it's above. I like to use the trick to distinguish a limit order from a stop order, in that a stop order is always the opposite of a limit. A stop order is you buy on the rise, you sell on a fall. The terminology stop comes from the fact that you're stopping the losses. On a long position, you open to buy, now you're going to sell to close, and now you don't like the price falling and you want to get out if it falls further, you want to stop the losses. On a short order, you open to sell, now you're going to close to buy, you hope the price falls, but now the price is rising. You don't want that. You want to stop the losses. Next thing we're going to look at is day specification as opposed to GTC, which is good till canceled. A day order automatically cancels at the end of the day if it hasn't been executed. A good till canceled, with most brokerage firms typically being 60 days, remains in there if it hasn't been executed, so you don't have to enter it the next day. There are optional specifiers called minimum and AON, all or none. These were applied to quantity. These specifiers are used for, I want a minimum, say 400 of 1,000 shares, or if I wanted 1,000 of 1,000 shares as a minimum, I would specify all or none. Those specifiers slow down the entry and are handled manually, whereas all these others are handled electronically. I've made a graph here to kind of visualize again the difference between limit and stop orders. I should note this applies to both open and closed, long and short. A buy order, you hope the price falls for you to buy it. A sell order, you hope the price rises for you to sell it. In both cases, those are limits. A stop order is the opposite. A buying, you don't want to buy on a higher one. On a sell, you don't want to buy on it falling. But typically, again, these are used by people in positions that are trying to close them out. They want to get out of a burning building. They're willing to take their losses. They want to stop their losses. So on a long position, you would sell, stop the losses, taking a loss. Notice the limit would have been to your advantage. And on a buy order, closing to buy on a short position, you'd like to buy it on a limit lower, but here let's stop the losses and buy it if the price goes against you. This is Dr. C Invests.